Hello and welcome back to Principles of Macroeconomics. I'm your host, Dr. B. And today we are going to be talking about the monetary system here in the United States, which is a system that we utilize to barter and trade for money. We're going to talk about things like the meaning of money, liquidity. A lot of business terminology will be included, and we're going to talk a lot about the concepts of monetary policy. So let's go ahead and we'll get started. Just before we get started into the chapter, I just want to quickly touch bases as to where we are in the classroom today. We are in week 11. There is a chapter 16 quiz that accompanies this week's content on monetary policy. Last week, you should have completed the chapter 14 quiz, chapter 15 homework. Week before, week 9, you had the chapter 12 quiz, chapter 13 homework. And next week, you'll have the chapter 17 quiz. So what does that mean? We are getting close to the finish line here, which is fantastic. Today's November 1st. We got about a month thereabouts left. So yeah, we're moving right along. So let's go ahead and jump into it, shall we? Let's talk about the monetary system here in the United States. And when we examine the monetary system, we're really talking about how money moves throughout the economy. Uh, back before we had paper currency, we had some way, shape, or form of an exchange for goods and services. Uh, whether that be a straight up barter, which is kind of like a trade, or whether it was you provide this service for me, I'll provide this service for you, or whatever, right? There's some type of exchange. And in today's economic environment, we use uh, money, for the exchange of goods and services. You provide me the good or the service, I give you money, right? That's the idea of economics. That is what we call an economic transaction. A transaction simply means that there is an exchange for goods and services for currency or money or some type of something with value, right? That's what money is. When you hear somebody say, "Oh, the value of a dollar is less today than it was last year or the year before that," to some degree, that's true because of things like inflation, which is what we're experiencing in 2021 now. But the when you hear the term the value of the dollar, it really means what is the power of that dollar? How far can that dollar go? That's what value in money means. It is how powerful is that dollar, right? It's a dollar a few years ago would get you a lot farther than a dollar today. Like if you think about like let's say for example, uh, you could get um, a burger and fries for a dollar. You could well a burger and fries for a dollar 10 years ago. Okay, uh, today that same dollar might get you just the fries, right? And why did that happen? It's because the power of the dollar shrank, the dollar weakened over time, and it happens for a lot of different reasons. One of those being inflation, which we'll talk a little bit about, and another reason would be the overall value of that dollar weakened because there's just not enough faith in the dollar carrying forward. And so there's a couple of reasons for a dollar weakening, but we'll talk all about money, right? That's what this chapter really talks about, and what economics is all about is money, and exchanging goods and services for another. So when we talk about money, we talk about things like bartering and we talk about actual physical dollars. A barter is very similar to a trade. And if you think about a trade, it means if you provide me with those goods and services, I will provide you with goods and services. That's a trade. So also what we call a barter. It's an exchange. Yeah. This happens frequently when there's something that I have that you want, or something that you have that I want. That's called a barter. Okay. Uh, and you might be familiar with that. Like if you ever exchanged something for something else, that's a barter, right? Uh, there's no physical currency involved in a barter. There's no like dollars and cents, right, in a barter. It's just goods for goods or services for services or goods for services, whatever, right? But there's no like dollars in that transaction. It's an exchange. Yeah. It's like, let's say you went to Macy's and you bought a red shirt, and you wore that red shirt for a year or two, and then you're like, you know what, I really want to get a blue shirt, and you're like, okay, I'm going to go on to Facebook Marketplace, and I'm going to find somebody who has a blue shirt who's looking for a red shirt, and I'll barter with them. I'll trade them, right? That's what barter is. And then later in life, uh, money came along, right? And we've been using money to make trade easier. How does it make it easier? Well, instead of like you exchanging goods or services with me, I simply purchased it from you, right? And that's kind of what that means. Meredith, that's a wonderful question. So Meredith mentioned the word quid pro quo, equivalent to bartering. To some degree, yes, that is very similar. Quid pro quo means this for that. That's it's Greek for this or that. It's the actual Greek terms, right? Quid quid pro quo. It is Greek for this for that. Uh, and so, yeah, that is very similar to bartering because you're exchanging this for that, right? So, yeah, I mean, you could say that is that's a very similar term. Of course, in recent years, that term, you know, takes on like a legal definition, but yeah, that's very true, and that's what bartering is. Absolutely. So yeah, I would say Meredith, yeah, that's probably accurate. And then so then of course money made things easier for us because instead of exchanging something for something, we would just buy it. How do you buy it? With money, right? It made the exchange a lot easier, and so money became an asset. That's how it became an asset because, uh, and those of you who know me from accounting, you know that the first asset in accounting that we talk about is cash, right? Cash is the most liquid asset of any company or any person, and so we use that asset, that current asset called cash, to buy goods and services, and to invest in the company, to grow the company, to make more money, right? That's the whole idea behind it. And so individuals use cash regularly to purchase goods and services from other people, from other vendors, or from other companies, right? And so, really, I like to think of cash as being like this, or money being as like this intermediary between you and the goods and services that you want. It's a vehicle that you use to acquire those goods and services, right? And that's how I like to interpret money, as being like an intermediary way of gaining another asset, or gaining a goods and services. That's kind of like the whole premise of it. So I just mentioned that cash is the most liquid asset, right? Liquidity simply means, in accounting terms, it means how quickly I can convert assets into cash. That's what liquidity means. How quickly I can convert assets into cash. What does that cash do? It helps us to use cash in the exchange for goods and services. So, how quickly and easily I can do that using cash to purchase goods and services is liquidity. It makes it quick and easy. When something's quick and easy like that, quickly converting inventory into cash by selling the inventory, that makes it easier for the business to grow. So when you hear liquidity, it means how quickly I can convert other assets like inventory into cash. And in economics, it works the same way, right? It's how quickly can I convert other assets into cash to then purchase other goods and services. And that's the idea behind liquidity. So I had mentioned, I like to think of money as being a medium, right? It's an intermediary piece between buying and selling. And that's true because we use cash to purchase goods and services in the economy. It really is this exchange. It's a part of the exchange process, and it's the intermediary. And we measure cash. We measure money. How do we measure money? We measure it by the amount we accumulate over time, right? You think of your bank account. Your bank account represents the amount of cash that you have in your possession, right? And it goes up and down, and we measure that cumulatively over time. We measure the cash inflow and the cash outflow. And that represents the unit of the account or the measurement. How do we measure cash? We measure it by the cash coming in minus the cash going out, right? And that's the concept that they say they use a yardstick to post prices and record debts. The yardstick is cash inflow minus cash outflow equals net cash flow, right? And those of you who took accounting with me, you already know that. We talked about that when we talked about the statement of cash flows. Cash inflow minus cash outflow equals net cash flow. It's the same exact concept, and it works the same way. Some people think that accounting and economics are really different, but they're really not. They really are the same. They go hand in hand. When you use cash, it has a value to it. Okay, we call it the store of value. It has value. And earlier I had mentioned that a dollar yesterday is worth more than a dollar today. Well, why is that? Well, because of things like inflation, the purchasing power decreased because there's too much of currency in the marketplace, etc. So a dollar has what we call a store of value. It represents the actual value of that dollar. How far can that dollar go? How much can I buy with that dollar? That's what a store of value represents. It's the purchasing power. And and we say it's from present to future. Why is that? Because a dollar tomorrow might not be the same value as a dollar today. It changes with a couple of different things. If you think about interest rate, which we explored earlier in this class, if you think about things like inflation or deflation, which we talked about earlier in this class, those types of things have an impact on the value of each respective dollar that you have. Just because it says $1 doesn't necessarily it's not the same to say that it's worth $1. A dollar can be worth more than a dollar or less than a dollar, and it depends on the stored value in that dollar. How far can that dollar take you? So if you think about like the dollar menu at McDonald's, okay? So let's say you go to McDonald's and you're like, oh man, I really want a burger and fries. So you go to McDonald's, and they used to have this thing called a dollar menu. Some places they still exist, but I think it was like earlier this year, in fact, that they removed the dollar menu from most of their stores. Why did that happen? Well, it's because the value of the stored value of the dollar decreased, right? It got weak. The dollar is weak now because of things like inflation and over time they lose less in interest or lose more in interest. So the stored value of the dollar is weaker. That's why a dollar does not go as far today as it once did. So that's what we mean by stored value. Cash can also be considered a commodity. Why is it a commodity? Because I can exchange that cash for other things of value. Yeah, yeah, Dario, you're right. It's like $6 or $7 menu now. Very true. But yet, so cash can also be considered a commodity because we can use cash money to purchase other things of value, like gold, silver, uh, Bitcoin, stocks, bonds, um, certificate of deposit. These other things, stocks, bonds, certificate of deposit, gold, silver, Bitcoin, uh, other metals, other commodities like corn, coffee beans, soybeans. These also hold value, right? Gold has a value, silver has a value, Bitcoin has a value. Uh, it has what we call intrinsic value. So if you think about it, if you use your money, your cash, and you invest in Bitcoin, we'll say, which has a current value of, I don't know, help me out here, Dario. What is Bitcoin at now these days? Do you know? Like $10,000 a coin or $13,000 a coin, something like that. No, you don't know. I can check. Who knows? Anyone help Dario out here? What's the current value of Bitcoin? Any ideas? I don't know what it was recently. I know it's something silly like $13,000 a coin or something like that. Anyway, but if you think about what the concept of commodity is being money, 60,000? You're kidding. Wow. Okay, so $60,000 a coin, $60,831.10 a coin as of today, according to Dario. Thank you, Dario, for finding that out. Uh, that's crazy. Anyway, if you think about it, you can exchange cash and purchase bitcoins, right? And what you're doing is you're storing that value in something else. We call that intrinsic value. Gold, Bitcoin, silver, uh, soybeans, coffee beans, corn, uh, you name it, right? These are commodities, and these commodities hold value. So we call that, we say that money has commodity because we can store money as something else. And that's what that means. Money could also have intrinsic value, which is what that means, right? We store it somewhere else. It has it has value even if it's not used as money. Like I might purchase a Bitcoin and never use it. Okay, probably not because it's a lot of money. If I never use it as money, it could still have intrinsic value. In other words, the value of the dollar is basically transferred into something that also holds value of that dollar. Does that make sense? That's kind of what intrinsic means. And money is also said to have what we call the gold standard. Well, kind of. Mostly, uh, there's some talk around this concept right now. In fact, even in the Congress and around the world, right now the U.S. dollar is used as the standard. Okay, around the world, it's used as the intermediary exchange for other currencies, which is kind of nice because that means that the dollar has a lot of value around the world. With gold, they said that gold is convertible on demand. In other words, if I buy a bunch of gold bars and I put them in a safe, and the value goes up and down, whatever, I can take a gold bar out of that safe, go down to the bank, say, "Give me the value of this gold bar in cash," and they'll do it. So that's why they say gold, the gold standard. Money is gold. Gold is money. It's kind of an old concept. It's been around since the 1930s. It kind of came about after the Great Depression during the economic crash of 1928. Uh, and it's kind of like we had to do something to store value, and that's what the United States did. The overall point to this concept is to help you to understand the actual value of a dollar, right? A dollar is not actually a dollar. A dollar is it has intrinsic value. I can convert that dollar into and purchase other commodities, and it still holds value. And then I can sell those commodities and turn it back into dollars. And the reason why people do that is, of course, to gain profit. Like, for example, if I'm like, you know what, I'm going to purchase 1,000 pounds of coffee on the open exchange, and coffee is selling for, we'll say, something like $8 a pound. Okay, if I buy 1,000 pounds of that, and then all of a sudden the value of coffee goes up to $10 a pound, I would then sell the coffee at $10 a pound and make a $2 per pound profit, right? That's that's why it's kind of like showing you how the the built-in value of the dollar can be exchanged for commodities and then sell the commodities and return back to dollars. I hope that makes sense. That how that works. I also say that money is what we call fiat money, or can be fiat money. Uh, Fiat. Let me explain fiat. Fiat is where money does not hold intrinsic value. Now, why would it not hold intrinsic value? Because something happened to that economy. Here's an example. Recently in Venezuela, was it 2 years ago now? I think it was 2 years ago. Might have been three. I don't know. Um, Venezuela uh, has a dictator who is running the country, and Maduro, and this dictator used the country's oil-producing companies and took them over hostilely. Okay, so now the country of Venezuela, controls all of the oil in Venezuela and controls the value of the currency in Venezuela. And so what happened is, because of this new government having too much control, the value of their currency fell to pretty much nothing. It was worthless. There was no value, right? So it became what we call a fiat currency. And so without that value, the country couldn't really grow, right? And so that's the idea behind fiat without intrinsic value. Another example is of the use of fiat is the debt ceiling. Oh, that's my favorite one. So recently, you all probably heard the United States is trying to raise the debt ceiling in order for the country to spend more money on various things like infrastructure and whatever. So when that happens, they're basically printing money that doesn't have real value. That's how you get to that point. And so that's the other concept behind fiat currency. We'll talk a little bit about those things. So here in the United States, we have this thing called the central bank. The central bank is responsible for the circulation of the actual coins and dollars throughout the United States. The central bank distributes that currency to other banks under their authority, and they control the quantity of the actual dollars and cents circulating throughout the United States. We call that money stock. Money stock is the amount of the actual currency, the physical dollars and coins circulating in the country. These dollars and coins are what we call currency. You all know that. I don't need to tell you that. Here's the other side of this. You use those dollars and cents to purchase goods and services. You also use those dollars and cents to save. When you save, you deposit into your bank account, right? That's the idea. Well, hopefully you're not putting it in the mattress because the mattress don't earn you money. So put it in the bank. So you put it in the bank, it generates this thing called an account balance. And you can access that currency at any time, whenever you need it, by writing a check. We call those demand deposits. When we talk about the currency circulating in the country for the amount of it, the stock of the currency, and we talk about things like deposits, we need to measure those things. And we measure them based on the utilization of the actual currency. And there are two standards of measurement that we use. One's called measurement 1 or M1, and the one's called measurement 2 or M2. In measurement 1, we're concerned about measuring the utilization of things like demand deposits, traveler checks, checkable deposits, currency, the physical flow, right? That's what we're really concerned about in measuring in M1. And in M1, we measure the flow of the actual currency in the United States. Measurement 2, we're interested in everything in measurement 1, but we also include things like savings deposits, small deposits, money market funds, mutual funds, stocks and bonds. That's M2. Now, if you look at those elements, okay, savings deposits, small deposits, money market mutual funds, minor categories like stocks and bonds, what that's actually measuring is intrinsic value because we're storing the value of dollars in things like security deposits, mutual funds, stocks and bonds. And so M2 is the measurement of the entire flow of money in the system, including things with intrinsic value. So here's an interesting graph, and I like showing this chart because it is a very stark difference. Yeah. If you look at M1, currency, demand deposits, travel checks, checkable deposit. This is the physical cash. Yeah. The physical cash in 2016 represented $3.2 trillion. Okay. Interesting. Interesting. Now, if you look at M2, which includes that plus savings accounts, small deposits, money market mutual funds, other categories like stocks and bonds, we see that the value is $12.4 trillion. Okay, huge difference. Why such a huge difference? Because the majority of actual money in the system in the United States is in things like stocks, bonds, mutual funds, money markets, and savings accounts. I sound like I'm on a fishbowl? Really? Who else is having that trouble? Can you all hear me okay? Test one, two. Test one, two. Is my mic? Well, that's a problem because I'm on my laptop. Try adjusting. I'll see what I can do. Is this any better? Starts good. Okay. Let me see. Hold on just a sec, everyone. I'm going to try to fix this mic real fast. It's good now? Okay. Thank you. Must have been just the way I was positioned in front of the laptop. I apologize. I'll also try to speak a little bit louder and clearer. Hopefully that'll help. Okay, so that's the graph. Moving forward, as I had said earlier, here in the United States, we utilize this thing called a central bank. The institution oversees the entire banking system and regulates the quantity of money in the economy. When you think about the central bank, think about a bank in Washington D.C. You know where we are, yeah, that controls the entire country when it comes to the banking system. That's why we call it the central bank. Think of it like the headquarters, if you will. We also have this thing called the Fed, the Federal Reserve. The Federal Reserve is the central bank of the U.S. And the reason for its existence is because early on in our country's history, 1907, 1913, 1927, we had a series of bank failures. Oh, I should also say 2008, 2009. We had a series of bank failures. The banks could not afford to operate. The banks could not afford to give people back their deposits. The banks could not afford to act like a bank. And so the government created this thing called the Federal Reserve. The idea behind it is that we would protect the investments, the savings of the country. How do we do that? When you go to the bank, there's a sign at the teller stands, yeah? The sign reads FDIC, So it's the deposit insurance something something something. I forget the actual FDIC part. Basically, what it means is your deposits are insured. So if the bank gets robbed or something happens to the bank, your account is insured up to a certain amount. I think it's like 100,000 or something like that. But the overall purpose was to really protect the banking system, to ensure the health of that system, to make sure that it works properly. That's what the Fed. That's why it was created. Federal Reserve responsible for S&L, savings and loans. I think that's what you're meaning, Meredith, right? S&L, savings and loans. Is that correct? Yes, yes, uh, yes. That's correct, uh, Meredith. Yes. So the Fed governs pretty much all of the banking in the United States, and the Fed ensures savings and loans and other methods of investing in the banking system up to a certain amount. I think it's like $100,000 per account or something like that. And but there's a lot of other establishments that the Fed made. They put in so many different uh, safety barriers. And yes, savings and loan was one of those uh, uh, situations in the 1980s that the Fed was partially responsible for. Yeah, wonderful question. Absolutely. So the Fed is organized with the Federal Reserve is organized with 7 members. You're welcome. 7 members and 14-year terms, appointed by the president, confirmed by the Senate. Janet Yellen, uh, before Trump, during the Obama administration, was the chairwoman of the Federal Reserve. And then currently it's Jerome Powell, who's the chairperson of the Federal Reserve. Janet Yellen, currently in this year, 2021, she is the, oh my God, I'm going to get this wrong. She is the higher position. She's the chief economic advisor, I think, or something along those lines. She's at the White House level, yeah. But the current chairperson is Jerome Powell. Janet Yellen had essentially retired from that position, and Jerome Powell was appointed to that position back in 2019, I think it was, thereabouts. And so anyway, so that person's responsible for directing the staff that works at the Federal Reserve, oversee board meetings, testify in front of Congress. They're appointed by the president for 4-year terms, and oftentimes those terms are renewed, especially if they're good. They sit in D.C., as you know. There are 12 regional Federal Reserve banks throughout the United States. There's one in New York, there's one in Los Angeles, there's one in Chicago, there's one in Miami. There's a bunch of other ones, and they're usually around major cities. And the way to think about it is you have the central bank, which houses the Federal Reserve, and the Federal Reserve manages these 12 other regional banks. Okay. So if you think about like you have a central office, and then you have a bunch of satellite offices. That's basically how this works. Same type of organization. A lot of companies have a similar organization to that. Working for the Fed, the Federal Reserve, what do they do, right? What does the Fed do? What are they responsible for? What are those people that work for them responsible for? They regulate banks, make sure they have enough cash on hand to pay out uh, withdrawals as they happen at all banks. They're responsible for managing the reserve banks, monitor bank conditions. They monitor clearing checks. This is my favorite one. They act as a bank's bank. What does that mean? So let's say you bank with I don't know, you're over at PenFed. Let's say you have an account with PenFed or Bank of America or uh, J.P. Morgan or whoever, right? So you have a bank account with one of those banks, whoever it is, and your bank runs into trouble. Okay, they need more cash, but they don't have a lot of cash coming in from the people that have accounts with them. So what do? They get a loan from the Fed. The bank, the Federal Reserve, is the bank's bank. That's the idea, yeah. And they're also known as a lender of last resort. They're like the firewall, yeah. One of the biggest responsibilities of the Fed is that they control the money supply, which is the actual quantity of dollars and coins circulating in the economy. They put cash into the country and take it out. Most of the time they're putting it in. Why is that? Think of this. Let's say that a bunch of U.S. residents decide to purchase goods and services from Canada or from Mexico or from Europe or Asia or Africa or wherever, right? What happens? Well, when you purchase something from another country, you need to convert the US dollars into that other country's dollars to purchase the goods and services. Basically, what you're doing when that happens is you're sending the actual currency out of the country to another country to purchase goods and services. That decreases the actual quantity of dollars and cents in the United States. And so the Fed is responsible for controlling that activity, the money supply. And they also set monetary policy. These are the policies around the money supply. How do they put money in? How do they take money out? That type of thing. And so the people that work for the Fed are what we call the FOMC. These are the members of the committee for the Fed. Yeah, there's 7 members on the board of governors. 5 of the 12 regional bank presidents, and they meet in D.C. about every 6 weeks. They talk about economic conditions, and they consider changes to monetary policy. Think of this as like the central government saying, "Hey, economy's going down. Let's pump more cash in to get it back up." Or if the economy's up really good, let's take more money out of it to slow it down. Those are the types of decisions they make. And so, how do they do that? They buy and sell government bonds. So think of this. Let's say you're investing, okay, and you're like, "Oh, Dr. B, I'm thinking about buying some stocks and bonds. Which one should I buy?" And I might say something. Well, depends on how risky you want to be. But if you're looking to be not as risky, you might want to buy bonds. A bond, what is a bond? A bond is kind of like it's similar to a stock, but it's almost like a private loan, kind of. You get a little bit of interest back. So you give the government, U.S. government, $10,000 in exchange for a bond. The bond says, I'll pay you back that $10,000 in 180 days at 6% interest. Sounds like a solid deal to me, but that's a bond. Okay. And the government buys and sells those in order to control the money supply. And that's their primary tool. Yeah. And of course, they'll increase money supply by printing more cash. They'll decrease money supply uh, by selling bonds. And the money supply itself is really dictated by the amount of the currency available and the demand for deposits. Banks can also influence the quantity of demand deposits in the economy based on the interest rates available for those deposits. Higher the interest rate, more deposits are encouraged, right? I might deposit more money in the bank if they said, hey, we'll give you a higher interest rate if you put more money in the bank. I would do that, right? So it's a behavior by the banks that influence people to do things like make deposits. Banks are required to have a certain amount of cash on hand at all times, regardless of what's happening. They must have a certain amount of cash on hand at all times, regardless of how many deposits or withdrawals they're experiencing. We call this reserves. And the reserve is like a safety net of cash that cannot be loaned out, but they must keep on hand. Okay? In most cases, the bank has what we call 100% of reserves. What this means is the amount of money received by the banks, by the individuals banking with that bank through deposits, the bank must hold that same amount on hand at all times. That's what we call 100% reserve. The reason why that is because if you all went to the bank at the very same time and said, hey, bank, I want all my money out of my account, the bank would have a very hard time sustaining their operations if they did not have proper reserves. So think of reserves as a safety net for the bank. Make sure they have enough cash on hand in order to meet all the demand from their customers. There's a couple of different ways that we figure out how much to have on hand. The bank needs to ensure that they have enough on hand at all times. We do this frequently, banks, by looking at their requirements, ratios, and what we call fractional reserve. I'll break it down for you. A fractional reserve simply means that we have a fraction of deposits on hand. So think of it this way. If there are 14 students in this class, and out of the 14 students, 7 students have savings accounts. Out of the 7 students that have savings accounts and they make regular deposits, the bank that they bank with will only have 3 out of those 7 students will have the actual cash in the bank set as reserves. Okay, that's what we call fractional reserve banking. It simply means that a fraction of all the deposits they receive, they'll have on reserve. It's one method to find out the amount that the bank should have available for withdrawals. Another method is called the reserve ratio. And it is, as you would expect, a ratio. fraction of deposits the bank has on reserves. It's a ratio. So the ratio might be like, oh, for every 3 deposits, we'll have 1 in reserves. So 1-to-3 ratio. The other method is what we call reserve requirements. There are minimum requirements established by the Fed. The Fed says every bank must maintain a certain reserve threshold. They must have a certain amount of cash on hand at all times, regardless of activity. That's what we call a minimum reserve. And that's a requirement set by the Fed. And of course, banks have the ability to hold more than just the minimum, which they should, by the way. We call these excess reserves. So here's an example. First National Bank has a reserve ratio of 10%. How do we get 10%? Well, the bank has deposits of $100. The bank has $90 in loans and $10 in reserves. How did we get the $10 in reserves? Well, we took 10% of all of the deposits. 10% of $100 is $10. That's how we got that ratio reserve. Let's take a look at a fractional. Break it down a little bit further. Banks will have fractional reserve as their method of reserves based on the bank's ability to create money through assets and liabilities, as well as an increase in money supply. This helps the bank to establish fractional reserves. And it's important to understand that this does not create wealth. What do we mean by that? Reserves are simply security nets for the bank. A security net does not create wealth. Okay? Think of some of you should, and you should have this, by the way. You should have a security amount in your bank account, right? It's like, oh, this is my what we call emergency fund. An emergency fund in your bank account, that fund does not help you to generate wealth. Okay? It's there for emergencies. You only touch it when your engine dies. You only touch it when you got car problems. You got other issues you need to take care of in emergency situations, right? That's what we call an emergency fund. The idea is it does not help you create wealth. Wealth is only generated when the cash is being used through investment strategies, like the purchase of mutual funds, stocks, bonds, other interest-generating activities. A reserve is simply a safety net. It does not help the bank to generate wealth. You may have heard this one. It's called a money multiplier. A money multiplier represents the amount of reserves established over time through multiplying the amount of reserves available. In this example, Second National Bank has $9 in reserves. Third National Bank has $8.10 in reserves. The loans are also follow the same trend line, so $81 for second, $72.90 for third. Deposits are also similar, 90 in deposits, 81 in deposits. The idea of the money multiplier is it does just that. So how does it work? Let's say there's $100 in an initial deposit. Okay, you deposit $100 into your bank. That bank lends the other bank's money. Okay, First National Lending will have $90, 0.9 times 100. Okay, Second National Bank will have $81, 0.9 times 90. Third Bank will have $72.90, 0.9 times 81, which means the total money supply of all the banks added up, obviously there's a bunch more, would be $1,000. The idea here is that we're using what we call the money multiplier effect. It's where the amount of money in the banking system generates additional dollars in reserves. It's a reciprocal process where the reserve ratio is 1 divided by the reserve rate. And of course, the higher the ratio, the smaller the multiplier. So the overall arching point behind this money multiplier effect is a form of generating reserves, is that the more accounts involved, there will be a higher total reserve amount for all the banks involved. That's the idea. It's not much more complicated than that. Well, let's switch gears a little bit and talk about a situation that caused additional change in our country. From 2008 to 2009, the United States experienced this thing called a financial crisis. What happened? We talked about this a little bit before in this class. We'd mentioned this crisis a few times, actually. So what happened is, between 2008 and 2009, is the banks engaged in this thing called predatory lending. They were issuing loans to buy houses at ridiculous rates to people that shouldn't have been able to purchase the house to begin with because they weren't able to pay back the loans. The banks did this kind of on purpose. The idea behind it was that they were going to generate a whole lot of profit because the loan amounts were at high percentage rates and everything was nice, right? Until the market collapsed on itself. Why did that happen? Well, the lenders engaged in this thing called mortgage-backed securities, where the mortgages were packaged together and sold on the open market exchanges to other investors at some certain rates that were what we call subprime. And that's what caused the housing collapse 2007, 2008, which then caused the financial crisis 2008, 2009. So the banks had what we call a capital crisis. Banks are required to have uh, owners of the bank in the institution, and they use bank capital to generate profit. Think of bank capital like owner's equity on a balance sheet. For those of you who have taken accounting with me, you recall that assets equals liabilities plus equity is the accounting equation. On a balance sheet for any company, including banks, they'll have assets on the left, liabilities and equity on the right. For a bank, our assets are reserves, loans, securities, and liabilities and equity are deposits, debt, and capital, owner's equity capital. And that capital, bank capital, is used to generate revenue. How is that? The owners of the banks put money into the institution, into the bank, to help the bank to generate more profit, to grow more, to generate more loans, to generate more reserves, to generate more securities, so forth and so on. And uh, and that's how banking really works. I mean, a bank is a business. So if you think of a bank, think of a business. So in order to understand what happened during the financial crisis, we also need to understand this thing called leverage. Leverage is how money is used to supplement existing funds for purposes of investing. In other words, I'm going to borrow some money from the bank to add to my current cash account to buy a business. And when I buy that business, I'm using that extra cash that I got from the bank plus my own cash to create this thing called leverage. And the leverage is basically a larger down payment, right, for the purchase of that business. The more leverage I have, the more flexibility I have as an investor. To understand leverage, we look at assets through a leverage ratio. And this leverage ratio is total assets to bank capital for a bank, of course. And so that leverage ratio gives us an idea of the bank's ability to have leverage in investments. And of course, as we take all this into consideration, we look at the capital requirement, which we talked about earlier. Capital requirement is a minimum required amount that the banks need to have on reserve to cover withdrawals. And of course, all that's regulated by the government. So let's think about housing, 2008, 2009. If the bank's assets, meaning the securities, which are the mortgages that the bank lends out, bank asset is a mortgage that you took out. That's an asset to the bank. Let's say the value of all the housing went up by 5% that the bank held. Why did this happen? Or what causes it to happen? The value of housing goes up and it goes down. And it goes up and it goes down. If it were to increase by 5% for some reason, the bank would see an, each $1,000 worth of assets being $1,050. It's 5% increase. Bank capital would rise from $50 to $100 and would have a leverage rate of 20. If there was a 5% increase in the value of the assets, it would mean that there would be an increase to owner's equity by 100%. So the bank, of course, would look very wealthy. If there was a reduction in home values or mortgage values because some of the borrowers defaulted on their loans, every $1,000 that the bank held would be worth $950, and the owner's equity would fall to zero. There'd be a leverage ratio of 20, and 100% fall in bank capital. Well, that's kind of what happened, right? The value of the mortgages that were bought and sold by investors on the open exchanges during 2007 2008 led to a 5% reduction in value in those mortgages because the mortgages were sold to people who couldn't afford them. The mortgages were sold at subprime rates. And guess what? The people defaulted on their mortgages. The banks had to retake the houses. Well, the banks do that at a loss. What if it was more than 5%? In which case it was during the 2008 2009 crisis. That happened because people who borrowed defaulted on their loans. There was a leverage ratio of 20%. The bank asset fell below liabilities. You know what happens when that happens, right? If your assets are below your total liabilities, what happens? Who can tell me? What does that mean? Don't all talk at once. Once answer that question. What happens when your assets are below your liabilities? What does that mean? We're in debt? Yeah. What else? You're broke? Yes. That's that is exactly what that means, Meredith. You're broke. Yes. That's what happens. So think of it. If your assets, remember, your assets are things like cash, property, plant, and equipment, inventory. Those are your assets. Your liabilities are loans, mortgages, accounts payable, wages payable, right? Remember, an asset is anything that you own. Liabilities are anything that you owe. And equity is what the owners own, right? So if what you own is worth less than what you owe, you broke. You going out of business. You can't afford to operate. If you're taking in less than what you're spending, you're done. The bank would be insolvent. Remember, solvency. Solvency means you have the ability to pay all of your liabilities, right? Insolvent means you cannot pay your debt. You cannot pay your liabilities. And therefore you are broke. As Meredith very elegantly said. Very well done. So yeah, you're both right. You know, you're in debt, you're broke, you're done, pretty much. That's what that means. So that happened to a lot of banks 2008, 2009. You know, what happened is they simply incurred too many losses. A lot of homeowners defaulted on their mortgages, and it led to substantial losses on their assets. And so what happened is you still have all these liabilities and you got less assets. That's a problem. And it led to, of course, banks not being able to lend any money because they didn't have any money to lend. Caused this thing called a credit crunch and a serious economic downturn that lasted for about 10 years. So yeah, that was 2008, 2009. That was terrible. It was a tough time. And so U.S. Treasury and the Feds, they stepped in and they tried to help the banks out. They said, "Hey, banks, you guys are too low on your assets. You got too many liabilities. Let's give you a hand." That's what. So central bank and the Fed, they rolled up their sleeves and they said, "Okay, let's get these banks set back up." So they came in, they pumped billions of dollars in to get bank capital back up. They helped out the taxpayers and the homeowners and tried to relieve the pressures. And they try to get things back to stable situation. So the nice thing about the Fed and monetary system is that there, from a central government, we do have a lot of influence on the amount of reserves. And the reserves really help the banks to keep operating to avoid situations like what happened in 2008, 2009. Uh, and it just provides that what I call the safety net, the level of comfort, the cushion, right? That's what reserves is. And so the Feds really helped out with that situation. And what happened with the ratio? Well, when the reserve requirements are met, the ratio is taken care of through the interest being paid on the reserves. When there are open market operations with banks uh, through the Fed, there's typically the purchase and sale of bonds from the Fed for U.S. government bonds, and that extra money supply or decrease in money supply helps to generate additional economic activity, and it makes the circulation of money in the system a little bit easier to do. If you buy bonds, you're increasing the money supply. If you sell bonds, you're reducing the money supply. And with that, of course, we're controlling the economy essentially, with respect to the flow of cash. And so the Feds lend money to the banks to increase the money supply to discount to a discount window at a discount rate, and it really does provide that again, the reserve, the safety net. That's the whole idea behind it. So I mentioned this word, discount rate. For those of you who recall when we talked about stocks and bonds, there is this concept called the discount rate. When you think of an interest rate, that's when you borrow and you have to pay back the principal balance plus interest. A discount rate is where when you take out the loan, instead of me giving you the principal balance or the principal amount of the loan, I'm going to give you an amount less than that called a discount. Okay. And you'll pay me back the full amount that you borrowed. That's why I call it discount rate. See, it works the same way as interest does, but you receive less principal cash up front. That's what a discount rate is. The higher the discount rate, there's a reduction in the money supply. A lower discount rate, there's an increase in money supply. Here's another term: auction facility. Auction. When you hear auction, think eBay. Kind of works the same way, right? Those of you who are old enough to know what eBay is. eBay is like a place where you can bid on goods. Yeah, it's like an auction website. So the Fed has something similar. It's called an auction facility. It ran from 2007 to 2010. In my personal opinion, I don't think it worked out well, but that's just me. At this point in time, the Fed set quantities of funds it wanted to lend to banks. And the banks would actually bid to borrow the funds. So it's kind of like saying, hey, banks out there, I got $10,000 I'd like to lend to you. And if I got 4 different banks, they would bid on those funds. Usually it went to whoever who wanted to pay the highest interest rate. Like I'd have an offer from the bank. Oh, I'll repay the $10,000 and I'll give you 6% interest. The next one would come in, 7% interest, 8% interest, 9% interest. And the banks with the highest interest rate were the ones that received that loan from the feds. It's kind of funny how that worked. But again, I don't. My personal opinion, I don't think it worked out as well as it probably could have. So let's recap a little bit here. The idea of reserves is that we provide a safety net in the event that there is a financial situation where the borrowers or the savers run on the bank to take all their money out. The reserve is a safety net for the bank. We have minimum amounts. The minimum amounts help to control the money supply. Increase the reserve amount, there's a decrease in money supply. A decrease in the reserve amount, there's an increase in the money supply. Why is that? Because the money's sitting in the bank, right? It's not moving. And so it's taken out of circulation. And it's efficient. It's something that we've been doing since 2008, and it works. So far, so good. Anyway, the banks do pay interest on the reserves, and those reserves are paid to the Fed. And when there's an increase in the interest rate, there's an increase in the reserve ratio, there's lower money multiplier, lower money supply. It's not perfect. The monetary system was never really perfect. It still isn't. It probably never will be. There's no such thing as perfect when it comes to managing and controlling the flow of cash in an economy as large as ours. So it's not precise. And the feds do not control things like the amount of money that households can choose to deposit in their banks or the amount that banks can choose to lend, right? So in other words, there's no caps on the amount that I can deposit. There's no caps on the amount that the bank can lend to me. So one of the things that banks fear the most is this thing called a bank run. This almost happened recently, actually. The economy started doing really poorly at the beginning of the pandemic. And so a lot of the people that had deposits in the bank accounts started going to the bank and pulling their cash out. They got scared, And so when that happens, if you have too many people withdrawing all their deposits at the same time, it could lead to a serious cash flow problem for the bank. And so that's why having something like a fractional reserve system may not always work. 100% reserve system, that would be best. Fractional reserve system, that would be bad in a situation where everyone's taking money out at the same time. Because they won't be able to satisfy all the withdrawal requests, right? So when too many people go to the bank at the same time and withdraw the cash from their accounts, the bank will be forced to close because they won't have the kind of cash to pay them. And they'll remain closed until they can get some loan money coming in, right? Or until they go to the Fed, the central bank, and say, "Hey, I need more cash." Well, that's why it's important that each bank establish a good reserve system and a good reserve amount to meet all kinds of situations. And the way that happens is the Federal Reserve does this thing called stress testing on the banks. A lot of this stemmed from what happened in the 1930s during the Great Depression. A lot of people ran to the banks, after the 1928 collapse of the stock market. And they ran to the banks and they started pulling cash out because the cash was safer in their hands than it was in the banks. And so that actually fueled the Great Depression when that happened. And during the 1930s, during the Great Depression, with that run on the banks couldn't lend money because they didn't have cash to lend. They could barely repay the people that uh, had the deposits, right? So it was pretty bad. In today's day and age, we have the FDIC, which I talked about early on. And the FDIC, they help to guarantee that the money that you deposit into the bank is protected. It's called the Federal Deposit Insurance Corporation. It's up to $100,000 on each account, and it basically safeguards your deposits in the bank. That's the idea behind it, and that's why there won't be any runs on banks in today's day and age. There is an interest rate with the Federal Reserve. It's called the federal funds rate. And this interest rate uh, really helps to fuel the Federal Reserve. Because, as you know, interest is a form of revenue for banks. And so the lender has excess reserves, borrower needs reserves, the interest rate will change. And there will be a change in the reserve rate also when there are other interest rate changes. Oftentimes, the federal funds rate closely follows the what am I trying to say? The daily interest rate on loans, similar to like the 30-year note, the 10-year note, 10-year Treasury note. Usually, it follows the 10-year Treasury note pretty closely. The Federal Reserve sets goals called targets where they want their rates to be at. And to accomplish this, the Fed will buy and sell bonds. And as they buy and sell bonds, there will be an increase or respective decrease in the money supply, and there will be a decrease and an increase in the federal funds rate. That, my friends, is how the U.S. monetary system operates. And look at that, we ended right on time. 7 o'clock. Are there any comments, questions, concerns? Anything at all? Anything that you can think of? I know it's a little bit more boring. This chapter was a little bit more boring than others. But are there any comments, questions, concerns? Anything at all? You all good? You all still there? All right, Dario's good. Okay, still here. That's good. Thank you, Meredith. Okay. Well, as always, if you think of something, if you need help, if you have questions, comments, concerns, you could always email me, call me, set up office hours with me. Whatever it takes, I'm going to be here for you to make sure you're successful. And with that, I'd like to remind you this, that we will have what chapter is it? We will have a chapter 16 quiz that is due this Sunday night. It is open and available for you to take whenever you're ready. And with that, as I always say, please remember to stay safe, wash your hands, and do all the right things. And I'll see you again next time. Thank you all so much for your time today. Appreciate all of you. Have a wonderful night, and I'll see you again. Thank you, thank you, thank you, as always.